Hello and happy Memorial Day to everyone out there. Today is Monday, May 31st, 2021, and doing a little bit more of a macro video to kick off the week here. Markets are closed today. Futures are open, but you can pretty much ignore that data. There's not going to be really any volume associated with that. But if we start by looking at the monthly chart of the S&P. I just wanted to highlight, going back to 2009, looking at the run-up that we've had, there's really only been, the pandemic pullback here in beginning of last year, and then a little bit of, flattening 2015, 2016. If you look at the time before uh, last year's sell-off, we did have a slight kind of a widening formation starting to form where we dipped down here at the end of 2018 and took out a swing low, kind of like we did back here in 2016, except we had put in a higher high, whereas in 2015, 16, we kind of made this um, lower series of lower highs. So as we see this extreme up move coming off of the pandemic lows, it's just good to remind ourselves, where we've come from the lows of 2009 and how far up we've come. And there's been some talk about stagflation and some ties to the 1970s. And so I wanted to scroll back to the 1970s on this S&P chart so we can see the general trend of the late 60s into the 80s, overall was up. We started lower, or we finished higher than we started. But if we look at the trend for the 70s alone, where we did have high interest rates and inflation and really stagflation, where we have a combination of um, higher unemployment and slower economic growth with that inflation or that rapid rise in prices that yields the stagflation. And so lower interest rates, which were then raised to curb or slow down the inflation. And right now we have, basically free money. And when we have that free money and there's a lot of borrowing, there's a lot of accessibility to borrow. And we see with the supply shortage that even if the demand coming out of the pandemic, even if we didn't have the pandemic, so let me go back to the current year. Even before the pandemic, the demand was, just slightly outpacing the supply. So we had a situation where you could operate, if you were a manufacturer, or as most of you have been familiar with the rise in building materials and lumber. Even before the pandemic, we were just slightly outpacing the supply with the demand, which, as for a manufacturer, is good. You can, with the just-in-time model, you're not hoarding a ton of or stockpiling a ton of, to use the lumber example, wood or building materials in a warehouse that's just sitting there. You're building it or you're manufacturing it and bringing it to production into the stores in a pretty quick manner with just enough to meet the demand. Um, and since the demand was just slightly higher than the supply, there was always that, okay, we could do a little bit more and serve the demand before we go too much. If we produce too much, then we'll meet the demand, and then the prices will start to fall. So we're already kind of in a tight supply and demand situation. So if we go back and just kind of look at what happened in the 1970s, a lot of, a couple of bigger declines relative to the time period in the S&P. Overall, market trending up, but I wanted to put on a couple